The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar, COVID-19 Real-Time Advice for Businesses, presented by our sponsor, Heffernan. We're so happy you can join us. My name is Deb Beto, and I will be your moderator today and be monitoring questions you may have during the session. Before we open up the session, let's review a couple of key items. We will send links to the webinar materials after the meeting today, including the audio, so please watch your email that you registered with for further information. If you have trouble with your internet connection during the webinar, we recommend leaving the presentation and logging back in. If you have audio difficulties or a telephone line goes dead during the call, hang up and call back again to the same number. If all lines go dead, watch the on-screen chat box for an alternative call-in number. Please feel free to ask questions or provide feedback by using the chat box or questions box during the webinar. If you are using a tablet, you may need to tap on the screen for the options bar to appear, and then you can select the appropriate option. We may not respond immediately, but we will try to work your questions or feedback into the presentation. If we can't get to your comment or question during the session, we will respond by email after the event. You may also email us at moderator@aspenrmg.com for up to 48 hours after the webinar. This will be a 1-hour presentation. Questions and comments are very much encouraged throughout, and the presenters will be answering questions at the end. And lastly, we have a number of webinars upcoming covering a variety of topics, including those listed at the Heffernan webinar website. In addition, we offer the mandatory preventing harassment training in English 3 times a year. With that, let's begin today's webinar, COVID-19 Real-Time Advice from Insurance Brokers, Employment Attorneys, and Tax Accountants. We have a panel discussion today from 3 different companies: Heffernan Insurance Brokers, Hirschfeld Kramer, and Armanino, the accounting firm of Armanino. Elizabeth Bishop is here from Heffernan Insurance Brokers, as well as Mark Paletta and Janie De La Rosa. From Hirschfeld Kramer, we have managing partner Steve Hirschfeld and also partner Felicia Reed. And from the accounting firm of Armanino, we have partner Matt Fricky, Shannon Oswald, and John Sweisberger. With that, I'm going to turn it over to Elizabeth Bishop to an overview of today's session.
Very good. Thanks, Deb. So good morning, everybody. And thank you for joining us today for what I think is really going to prove to be a timely and informative session for everybody. You know, we had over 600 participants last week, and we have about that same number this week. So you're not alone in having a really strong desire to get very timely information about what is going on and how you can proactively take control from either an insurance, employment law, or an accounting standpoint and get some best practices around SBA activity and the like. So I wanted to note that this webinar is going out as a nationwide resource, but Maine, Heffernan regions are actually going to be conducting their own webinars. For instance, our Midwest region is going to be hosting sessions beginning next Tuesday, and they're going to run Tuesday, Thursday sessions through April, and they're partnering with Busey Bank and Stock Legal. So for those listening in from the Midwest, please get a hold of Mike Boone and the team there in the Midwest and tune into those sessions, because I think they'll be very regionally well attended. Last week we had well over 60 questions that came in, and we are working diligently to get at least basic core answers to those questions from each of the speakers from last week, and we were able to field 3 questions actually. And ultimately, we think we're going to probably get somewhere between 3 to 5 questions answered today, and then we will do another, sending it out to everybody in terms of the answers. And so you do expect that you're going to get some good Q&A from this as well in writing, okay? And we're going to try to send that to all attendees. So with that, I would like to introduce to you Mark Paletta, who is a Senior Vice President here at Heffernan Insurance Brokers and is a person that runs our benefits session in co-leadership with Janie De La Rosa, who will also be speaking here shortly as well. So take it away, Mark.
Thanks, Liz. I appreciate it. Good morning, everybody. So I think what we want to focus on today is, let me switch the slide here. We want to talk about it from a benefits perspective. So talking about group health and welfare, I think Liz mentioned it best in the intro, which is want to take control and see where there's flexibility from a cost perspective, what's happening obviously with COVID. So we want to talk about really the group health and welfare specific to health insurance carriers' response to the crisis. I think, as you can see on the slide right now, I say so far because this is a very fluid situation and things are changing and guidelines are being updated as we go. A lot of the things I'm going to talk about right now are really going to be specific to how current contracts currently work in relation to how premium payments are made, how eligibility is processed, both your internal protocol and looked at from a carrier contractual perspective. And then we're going to talk about coverage levels as well. So both standard practice as well as the concessions that are being considered on the carrier level. So like anything, I think we did this last week as well, we have to say the disclaimer because this is such a fluid process. This information is intended to be just general guidance. So everything that I'm going to be covering and Jamie's going to be covering is, right now as it's going, we just want you to make sure and look to your current contracts and your specific vendors. But I want to give you the guidance and kind of the general overview to make sure that you know where the squishy spots are to assist during this time. So information and guidelines are consistently being reviewed on a daily basis. I think that's really important too. So we're trying to get the information out to you fast, but we're trying to make sure that you're not being misinformed and it's accurate information at the same time. So you will see updates from us coming out on a regular basis. You can reference our COVID Reference Center on our website to go through those updates for those guidelines and process and procedures going forward as well. Okay. So talking a little bit about how the group health carriers and how they're responding to the COVID crisis, I think premium billing is probably the #1 question. From a cash flow perspective, I think it's really important to understand kind of what abilities you're going to have from the normal standard perspective to what is being the concession that's being made from the carrier perspective. So we look at it and say, grace periods, payment leniency, or delayed payments by employers. That's something that I think is probably the primary question that we're being asked right now, because a lot of your employee and staffing decisions are being made on, what your cost structure is going to be for programs like, your group health insurance. So most plans have grace periods in place right now, whether you know it or not. Most plans have, a 30-day grace period. So for instance, if your premiums are due on April 1st, most plans have a 30-day grace period, so you have to be paid up by April 30th. What I can say is that while some carriers have responded saying they'll either extend grace periods and suspend terminations for the month of April and March, all of them are saying they're going to review on a case-by-case basis. So the key point here is to go back to your current vendors and carriers and basically say, if there is a situation where you think you're going to be going beyond the normal standard grace period of those 30 days, bring it up to them, work with your advisors to kind of create that additional runway you may need to get that payment done, because they are making and are allowing for flexibility for those terms. This is for both fully insured and self-funded contracts. We're seeing that as well. These are on a case-by-case basis, so it's something that you do need to talk to your particular vendors about, but it's important to know that that flexibility is being exhibited. Another big question I think that we're getting on a regular basis is cost sharing with employers. From that perspective, it's will basically health insurance carriers be reducing premiums? I can say that across the board that has been indicated as it's not likely they're going to be reducing premiums or providing any sort of rating discretion during this period, especially if you're in the current course of your contract. However, the next bullet point down, you can see that the Paycheck Protection Program, the PPP, which we'll be getting into a little bit further in the session, a little bit more specific detail, it has been identified that health insurance premiums, due to their relationship with payroll overall, as defined as payroll costs, are identified as an eligible expense if you decide to go through the SBA loan program. So that could help provide a little bit of additional aspect for payment if you decide to pursue that route. So that's something that we did want to mention, that health insurance premiums are included as an allowable expense. As far as eligibility to continue coverage, I think this is another important feature because eligibility in your membership is going to dictate how much you're actually going to be paying for your health insurance costs. So a lot of organizations right now are making those staffing decisions, and they're either reducing hours to part-time or actually furloughing employees, so those temporary layoffs. And most all health insurance carriers are allowing employees to stay on as active participants on the plan as long as the premiums are being paid. Obviously, this reverts back to the grace period. So there's additional grace periods that are being offered to pay those premiums, but as long as you're abiding by and staying within those payment rules and those standard practice, and you're reducing hours for folks or furloughing employees, they still can be considered active employees on your benefit plans. You do not need to terminate them if they drop below the normal threshold in your contracts of they need to maintain a certain amount of hours worked per week. So I think that's really important because a lot of us are making those decisions going forward, and I think this is something that we need to track, and we will be getting out guidance going forward. But most of them are considering that to be allowable for the months of April and May at this point. But again, I stress that you check with your current contracts to make sure that's staying within kind of their eligibility guidelines. Once everything kind of settles and the dust settles, COBRA and rehire waiting periods, I think that's another important feature, just due to the fact that once we're bringing people back on, if we do go beyond a certain amount of time, beyond April, beyond May, and we do end up by having to make those tough staffing decisions of terminating employees, if you do hire them back once the engine starts running again, do they need to resatisfy your eligibility standards that you have built in your contracts? A lot of plans and contracts already include the aspect that you can rehire an employee within a certain amount of time without them having to satisfy or resatisfy your eligibility parameters to make them benefits eligible. Most carriers, again, are coming out with the stance that they do not need to resatisfy if it's not already explicitly stated in your contract, that they do not have to resatisfy the eligibility parameters and waiting period to be eligible for benefits. So I think that's a key point as well. I've seen the majority are saying through the month of May, some are saying through all the way to July that they don't need to. If you bring them back on board in a full-time capacity and you didn't terminate them, they will not have to resatisfy that eligibility period. Now, going through the actual coverage parameters, I'm going to turn it over to my colleague, Janie De La Rosa, and she can speak to actually some of how the benefit coverages that maybe weren't explicitly stated, again, in the contracts, the additions that are being offered by the carriers.
Thanks, Mark. So in terms of the group health and carrier markets and the coverage, wanted to point out specifically some benefit modifications that we're seeing enhance the contracts related to the COVID-19 crisis. First, wanted to just mention quickly on the testing. That bullet is down on the bottom, but wanted to start out with that. Most carriers are now adding extra language to their plans to ensure that coverage for COVID-19 is covering testing as well as treatment. And it is being looked at as an essential health benefit. Now, all of this testing and coverage is basically changing with your carrier, so I would advise that you check with your carriers specifically. However, we are seeing that if you are directed by your physician or your employees are directed by a physician to have this testing and treatment, carriers will now cover that at we're seeing $0 copays. In addition to that, on the telemedicine feature, we're seeing a lot of carriers, most have a teledoc or a virtual visit feature that's embedded in the contract. Currently, you may have that covered at a copay, and this feature is basically turning to a $0 copay we're seeing by most carriers. So I would say the majority of the carriers out there do use a teledoc, the actual teledoc system. However, there are some carriers that have their own virtual visit. So again, we advise you to check in with your carrier to see which portal they're using, as well as verify the co-payments. But we're seeing them go to $0. Now this brings us into the next subject, which is high deductible health plans, because many of us have high deductible health plans, HSA plans, HRA plans. So a high deductible health plan, if you have a deductible over $1,500, what we're seeing now is that carriers are allowing employees to have any kind of testing related to COVID-19 treatment without having to meet their deductibles first. Now, this is a big deal because the IRS has to approve this because of the guidelines that are featured in high deductible health plans. So the IRS did approve it on March 15th, and now you are allowed to have $0 coverage even if the deductible has not been met. It appears that some plans are extending this for 90 days all the way to TBD, to be determined, so no end date. So, you know, check in with your carrier on that. And then, again, contracts, your official contract may be amended as well. And I believe that is what we have to share on. Oh, one last thing on the HSA contributions. If you currently, you or your employees are contributing to the HSA banking, that can continue, even though there will be $0 coverage with your carriers. That will continue. You can continue to deposit pre-tax dollars into the banking account. So with that, I'd like to turn it over to Stephen Hirschfield and Felicia Reed with Hirschfield and Kramer.
And Steve, you are on self-mute, so if you can unmute yourself.
Okay, sorry about that. I think you can hear me now. Good morning. Thanks for inviting me. Felicia and I are going to talk a little bit about some of what have been pretty complex employment laws. For those of you who were on the line last week, you'll remember that we talked about two very important but quite ambiguous and difficult to understand and apply federal laws that dealt with federal leave and paid sick leave. Over the past week, thankfully, the U.S. Department of Labor has issued a long series of regulations and Q's and A's, getting us to better understand the application of these new laws in the real world. What my partner Felicia Reed has been doing is literally spending nights going through this and trying to parse it so that we can give our clients some practical guidance on how these laws are actually going to impact them. And what she's done is put together a series of the top 10 or so questions that we've been getting concerning these new laws. And I'm going to turn it over to Felicia to go over that right now. Please just keep in mind, she's going to give you some general parameters of these questions and answers, but every one of these is really going to have some nuances that'll be impacted by your individual business. So we'll certainly want to give you some guidance on this. We need to encourage you to speak with your lawyer to talk about how this might apply in your particular situation. So with that, I'll turn things over to Felicia Reed.
Hey, thanks, Steve. So, yeah, this is going to be pretty high level, but one of the first question that we are asked is, how do I know if I qualify for the large employer exemption? And this is, there are lots of companies that will qualify for this. You count all employees, whether they're full-time, part-time, temporary, including those that you may be hiring through an outside temporary agency. So they're counted too. You count joint employers, where 2 or more employers are directing the work of the employees. All employees of both employers or all joint employers are counted. Another issue that's coming up is where there's a complex structure of the employer, where there are, separate entities, separate subsidiaries, let's say, but they actually are all integrated for purposes of delivering services. And if they have common management, their operations are interrelated, there's centralized control of employment issues, personnel, labor relations, and there's some common ownership or financial control, all of those entities can be considered an integrated enterprise, and all the employees counted. So and the counting is real simple. It's as of the date that leave is taken. So if there are massive layoffs going on and an employee requesting leave after those layoffs may need to be given leave if you've gone below the 500 threshold. And I wanted to just, this is for Los Angeles employers. LA just adopted an ordinance requiring paid sick leave for employers of 500 or more. So if you're in Los Angeles, look at that. The next question we get, hey, I'm less than 50 employees. I saw in the laws that I might not have to provide paid sick leave or emergency FMLA, do I? Well, it really depends. All the law did was authorize the DOL to exempt employers of 50 or more under certain circumstances. And last weekend, the DOL came out with guidance that says you can, if you're under 50, you can only deny leave requested to care for a child due to the closure of the school or child care provider. If the employee requests leave for their own symptoms or a family member's symptoms, some kind of COVID-19 related reason, this exemption does not apply. In addition, to qualify for the exemption, you need to be able to establish that giving leave would threaten the viability of the business. And the DOL came out with specific findings that need to be made. I'm not sure we have to go over them right now, but basically an officer of the company needs to determine that the finances would be severely impacted and you can't do without the employee. Now, what about employers of less than 25 employees? There's also a provision that says, hey, if you have less than 25 employees, you may not, you may have some exemption here. Well, the exemption is only from reinstatement. You still need to provide the leave. If you're less than 25 employees, you have to show that it would be an undue hardship to return the employee who took leave to their position. And again, this is only where the employee took leave to care for a child due to a closure. So could you go to the next slide, please? Another question that we've been getting is, what healthcare providers can be denied paid leave? And the DOL has issued guidance on that. It's really broad. It's anyone who is employed at a doctor's office, a hospital, a higher ed institution offering health care, medical school. It goes on and on and on. So you certainly have that ability to deny leave if they are involved in a healthcare operation of any kind, whether it's a receptionist or the doctor itself.
Hey,
Now,
Felicia, one of the
yeah.
questions we're struggling with are we've got a lot of manufacturing clients or other providers, companies that have a nurse on staff or somebody that deals with first aid as a first responder when there are accidents or people are injured. Has there been any clarity yet on whether a company can say, we're not a healthcare provider, but this person provides healthcare and we need to keep him or her going. We can't allow that person to go off on leave.
I think if you can demonstrate that person is actually providing health services and works out of a healthcare center or clinic on site, I think you've got a good case. But I do need to tell you that the DOL is encouraging employers to be conservative in using this exemption, because, in other words, in close cases, you should grant the leave request because they're extremely concerned about the spread of the virus and about employers taking advantage of situations where they don't really need that person on site. So with that, I think a case could be made. Do you really want to make the case? Next question, and by the way, it's not top 10, it's top 9. Do I need to provide paid sick leave or emergency FMLA leave to employees that are either temporarily furloughed or laid off? And the answer is now very clearly no. These people will be eligible for unemployment benefits. Okay, the theme that comes clear in the DOL guidance is that is how to figure out if you need to provide leave. Do you have work available for the employee? If the answer is no, there's nothing to take leave from, and that employee should file for unemployment. Okay, so this is in a furlough or a layoff. If work is available, whether on-site or telework, and the employee is not able to perform it due to a covered reason, then that's where you look and see if paid sick leave or paid family leave is available. So if you have full-time telework available and the employee can't perform it because they need to do full-time childcare, then they may be entitled to the paid leave. Do I have to allow, if I've cut work hours due to, the conditions that are going on right now, do I have to allow the employee to make up the cut hours with paid sick leave or family leave? And the answer is no. Again, the leave is not available due to a lack of work. So if you have given an employee a reduced work schedule, you don't need to provide paid leave to make up the difference. And if you do, by the way, you won't be eligible for a tax credit because that's not what this is to be used for. Again, this is a situation where employees should apply for unemployment benefits, which certainly in California, they're available for reduced work hours. And I think there have been the encouragement on behalf of the federal government for states to adopt those programs that don't currently have them. Okay, next slide. This is the opposite side of that question. I have full-time work available, but the employee doesn't want to work full-time because of some covered reason. This often happens when an employee has childcare, that children are at home because the schools are closed. Comes up a lot. So for example, if the employee is telecommuting full-time but requests a part-time schedule and then wants to make up the difference with paid sick leave because their child is home, do you have to grant that request? Well, in this case, you have the work available, the employee doesn't want to perform it 100% of it due to childcare, can you give them reduced schedule paid sick leave? And the answer is yes, you may, but you are not required to. So this is a situation where the paid leave is optional to make up for the reduced hours. That said, the DOL is encouraging employers to provide employees with paid leave in this circumstance. If you do provide leave that you are allowed to but not required to provide, you will be eligible for the tax credit. Now, that's if an employee is telecommuting. Okay, that's a simple issue. If the employee instead is going into a work site away from home and you have full-time work available there, but they want a part-time schedule, you can only grant that option voluntarily if the leave is to care for a child. If the employee is requesting intermittent leave to care for an ill family member or a family member who has symptoms or is under quarantine, the answer is no. Cannot provide intermittent leave. The DOL wants to encourage people to stay home in that instance. Next, may I choose to provide paid sick leave or emergency family medical leave if I'm not required to? Absolutely, you can do that. But two caveats. Number one, the employee could well be eligible for unemployment in that situation. And then unemployment, especially with the federal expansion supplement, may well be very favorable to the employee. Second, tax credits are not available for paid leave that you provide that doesn't qualify for these emergency paid leave laws. Finally, and this is kind of the $64,000 question we've all been waiting for, and just over the weekend, I think it was Sunday or Monday, maybe yesterday, the IRS finally provided guidance on what kind of documentation you can require from employees to verify the need for leave. And why the IRS guidance is important is because this is the documentation that you will need to give the IRS to verify your eligibility for the tax credits. So here we go. Require a written request from the employee, providing the name and the dates, a statement that the reason for the leave is related to COVID, a statement that the employee is unable to work, including telecommuting because of that reason. If the reason is a quarantine order or self-quarantine advice, require the name of the governmental entity ordering the quarantine or the healthcare professional. If it's based on school closure, the name and age of the children. And by the way, this is critical. A representation that no other person will be providing care for the child during the period you're providing paid leave. This is new. Okay, so you can condition giving paid sick leave, paid family leave on no other person being available. Also, for child care for children older than 14, you should require the employee to state and verify that special circumstances exist requiring the employee to provide care for those older teens. Okay, so those are brand new and answer some of our questions about child care. So
Great.
Steve, any questions for me?
Well, I think what we should probably do is move on, and then I know there's some questions we can cover at the end. I'd like to turn things over to our friends at Armanino, and specifically Matt Fricke, who's going to talk about some of the most important tax issues and loan issues, loan forgiveness issues that I know a lot of us have been waiting to get guidance on. Okay, Matt, take it away.
Thanks a lot, Steve. Appreciate you guys taking time. We have a few topics to talk about today. I'll talk general overviews of what happened in 6201 and the CARES Act. And then we'll jump into specifics as it relates to the payroll tax credits and deferrals. And of course, John's going to wrap up with the SBA loans and whatnot. So we can click to the next slide. I think what's important to understand is that HR 6201, the first bill that passed, really was to support federal and state governments, right? Unemployment rolls, provide medical assistance and emergency funding. What happened in the CARES Act took a much broader stroke and really kind of shifted some of that cash needs to corporations to keep their employees. So versus sending employees to the rolls of unemployment, let's provide support for the companies to keep their employees in place, keep the economy moving, and that's a quicker relief. If you go on the unemployment rolls, it takes time. It's a process. This way, the employers can directly impact the employees by keeping them on the rolls. But we'll get to the details. There's a host of important things as it relates to corporations. I just wanted to highlight for people. If you have any kind of a corporation that paid any tax over the last 5 years, you need to pump the brakes and look at the CARES Act. Specifically, you have NOL carryback provisions that took place for anything after 2017. So that goes up to 2021, and you can carry the NOLs back 5 years. So something to look at and think about. It's going to be needed cash for a lot of companies out there. The runway is getting tight. So just think of that. The NOL limitations that were in place under the TCJA rules have been lifted. There was an 80% limitation. Now you're allowed to take 100%. The 965, the toll charge that took place, a lot of provisions out there on the toll charge. There's elections to be made on the carryback of NOLs, and we have to be thoughtful in the process. Right now, the 20% tax rate is what it is. A few years back, it was 35%. So there's some value in carryback, but there's some offsets with 965. So just be aware of these issues. Interest under 163J, it used to be a 30% limitation, has been raised to 50. There's all kinds of things on AMT credit accelerators. If you had taxpayers that paid tax and they need cash now, you can go back and claim that AMT credit, accelerate it, and get a refund. And so we're advising a lot of our clients right now to look at the last 5 years, analyze it, lay out the game plan, and work through the details. A lot of our clients are looking for cash needs. How do we preserve the cash? How do we slow the cash burn and lengthen the runway? And that's what we're focused on right now. As a group, we've developed a rapid response team to address each of these issues. If you look at the CARE Act, the drive cash relief, thank you for switching the slide, that's perfect. The employer retention credit, 2301 section, the delay of payment of employer payroll taxes, which John's going to talk about with the interplay with PPP loans. And then the government provides relief funds. That's been several different programs, and a lot of companies are running up into a wall on the PPPE, under 500, affiliated rules, look-through rules of ownership, all that John will take care of. But it's something to think about, and if the worst case scenario, if you can't get one of the two programs, there's a Title IV loan program with the government that John will also touch on. The other thing we've been seeing in a lot of the companies is negotiations with states. So we've been successful in negotiating with many states on sales tax, on property tax, on any kind of business tax or city tax to really reduce that cash burn, delay that cash burn. And lastly, we've been looking at economic transactions. If you have a corporation that's a multinational, which in Silicon Valley is pretty much every company, they have to have comparable analysis for economics to how they pay and compensate their related parties. Sometimes it's 5, 7, 10%. We've now had comparables that would drop that down an extra 2%, which is going to save you on the dead tax overseas, foreign taxes. That's a waste of cash at this point. You can reduce that, save money, preserve money, and keep it in the banks of the U.S. But that's as an overview. That's kind of where the corporate world is. It's robust. It's complicated. Every time we have a new corporate law come out, a new legislator come out, it keeps us busy for a long time. There are some time crunches in here when you want to file your 19 return to avail yourself to carryback. So just be aware of all the interplay. If you go to our website, there'll be a COVID-19 page that'll click through some of these cash runway preservation techniques. Highly advise you to direct your corporates that way. But most importantly, I think people are going to be concerned mostly on the 2301 and 2302. So I don't want to take up all the time on corporate world. I can hand it over to Shannon, who's one of our partners in our HR and boss group, and she can talk a lot about the payroll side and the credits therein. So we can click to the next slide and then have Shannon take over. That'd be great. Oh, I guess we're going to go to John first. John, you're up.
Actually, let's go back one slide and let Shannon dive in a little bit on kind of there's a lot of questions around the payroll tax stuff. So Shannon, you want to talk a little bit more about those?
Yeah, absolutely. So good morning, everyone. I'm Shannon Oswald from Armanino in the consulting group. There are a lot of questions about the payroll tax deferrals and the payroll tax credits that employers can get. So first, I'm going to talk about the delay of payment for employer payment of taxes. So this is called a tax deferral program. It's part of the CARES Act. And what it basically says is that companies will be able to defer the 6.2% employer portion of Social Security tax. The period for this is March 28th, 2020 through the end of the year. The deferred tax amount that wasn't paid during that time will then be paid back over 2021 and 2022. But it's a significant way to maintain cash during the time that a lot of companies are strapped, and then essentially be able to pay that out over a couple of years. And it can be, a pretty significant amount of money. So the issue with this is that both the payroll processors and the IRS need to do some preparation for this. If employers are going to start deferring their taxes, the payroll processors need to adjust their processing platforms to enable people to not submit those taxes. And my group at Armanino is essentially, we have a lot of payroll processors and payroll professionals that have been in close communication with the payroll processing companies, ADP, Shore Payroll, Paychecks, some of the PEOs like Augusto or a TriNet. We're talking with all of them. Some of them are already ahead of the curve and making these changes. Some of them have not issued guidance yet on what they're going to do with this. So our guidance is talk to payroll processors, work closely with them, see what they're doing. If they're not able to support it, the IRS is going to have to adjust the 941 quarterly tax reporting form. They're talking about issuing a 941X form that can be used with the additional edits that will allow for reporting of the tax deferrals. A lot of the states that we're seeing are following the federal example. So for instance, California, as part of their emergency response for COVID-19, is allowing employers to also defer their payroll tax deposits and filings for up to 60 days. So using California as an example there, but it's not just a California specific statement. If you have businesses in other states, it's, I think, imperative to educate on what those other states are doing, if anything, and be aware of what's going on at the state and potentially local level for some states that have local taxes. So as a recap for that, payroll companies may or may not support the payroll tax deferral, or they may have a learning curve while they make their adjustments in order for the processing of payroll to allow for these immediate changes. It's possible that they may have stipulations that as a client of theirs, you have to go through if you're taking advantage of the federal or state payroll tax deferrals. So at the end of the day, ultimately, it is the company's responsibility to assume that they are essentially culpable for the deposits and filings for the rest of the year. So however that has to happen, whether it's support from the payroll processor or support from the IRS via the changes they're making to their platforms or their forms, that is essentially the payroll deferral process. And that, as you can see on this slide, is section 2302 under the CARES Act. The second thing I'll talk about very quickly is the employee retention credit for employers, section 2301 of the CARES Act. I know I did my bullet points in the wrong order there. Sorry about that. So the employee retention credit is, it has been a little bit set back because of other things that are available. basically, the credit for payroll taxes is not available to employers that are receiving a small business interruption loan, essentially the PPP, Paycheck Protection Program loans. So employers may find that the PPP loan is more beneficial to their business than this payroll credit. For small employers that are eligible for a PPP loan, they might find it more beneficial to get the PPP loan and then do the first process I just talked about, which was the tax deferral. They can do both of those things, but they can't do the PPP and then also get the tax credit. So the retention credit is really, in my mind, more of a benefit for larger employers that do not qualify for a small business loan like a PPP or even an EIDL and EIDL loan. So essentially 2 different audiences for these 2 different offerings is how I interpret it. Keep in mind a big employer with more than 500 employees or 500 or more is going to have to show that they are severely impacted in order to get the tax credit. So those guidelines are still going to be there. Under the employee retention credit, eligible employers are essentially entitled to claim a tax credit of up to $5,000 per employee. It allows payroll credits for employers who have to provide paid leave to employees affected by COVID-19. And it's based on economic impact on an operating business. So there are provisions by which businesses have to show that they are eligible for this type of a program. They have to be operating suspended by orders in response to COVID-19. They have to be carrying on business during calendar year 2020, and they have to have suffered a significant decline beginning with the first calendar quarter, basically of 2020. I think the verbiage says after December 31st, 2019. So you basically have to show gross receipts that are less than 50% of gross receipts for the same calendar quarter in the previous year. And then their eligibility will end with the calendar quarter that shows gross receipts greater than 80% of gross receipts from the same calendar quarter in the prior year. All right, so there is a lot of information out there talking about eligible employers, eligible employees. I will say that the size of the employer is for the employee retention credits can be available. I'm sorry, the size of the employer is eligible for larger employers, not just a small employer that may be eligible for the SBA loans. So I hope that's clear. I'm going to pass this over to John, who's going to talk about the SBA loans, and a lot of that will dovetail into this same information.
Thanks, Shannon. Yeah, it's clear as government programs go. There are myriad arcane nuances to these things, certainly. So certainly encourage everyone to make sure that you are checking with your tax and legal professionals as it goes through these various programs. Let me talk a little about the loan programs that are part of the CARES Act. So there's a couple of different things. There's Title I, which deals with small businesses, and Matt alluded briefly to Title IV, which deals with large businesses. I'm going to cover off the Title IV without really talking through the slide here. Title IV is for businesses that are 500 to 10,000 employees, and there's of course rules around what makes an employee and everything. I won't go into those. The details of that program are basically unknown at this point, how one would apply for, what the requirements would be. Do know this, if you're one of those size companies, there's going to be a pretty stiff test of being able to prove creditworthiness and putting up collateral and things like that around those loans, but the definitions are not yet released. Obviously, this is all brand new information as of a couple of days ago. That program overall, though, does have over $450 billion appropriated to it, so it's a fairly significant program. Unfortunately, I just can't give you too much details on it. So most of what I'm going to talk about here is for the smaller employees, 500 and under. And there are effectively two loan programs. What came out of the CARES Act is the Paycheck Protection Program, or PPP. And there are also these EIDLs, economic injury disaster loans, that are not related to the CARES Act particularly, in that they are disaster loans that are generally available after, you'll hear about disaster relief after a hurricane or a tornado or some other natural disaster for businesses. That's what EIDLs are. So that facility has been in place for a long time by the SBA. But there's some unique aspects of that as it relates to the CARES program. I'll get into that in a minute. And then the economic injury grants, the EEIGs, is a subset of the EIDLs, and I'll touch on that very briefly as well. And we've already kind of covered the tax relief provision. So if we could go to the next slide, try to give you the basics of what these two programs are in as simple of a form as I can. So I'm going to kind of deal with them one at a time. The PPP program, Paycheck Protection Program, is a brand new program put in law by the CARES Act. It allows for as much as $10 million. That's the maximum loan available. However, your particular maximum loan amount is going to be a function of your monthly payroll, your average monthly payroll. There's a bunch of things that go into payroll costs. I won't go into the details here, but it's not just, hey, what's my my monthly check that I'm writing to our people. There's health insurance premiums and other things that go into that. So overall, it's 250% of your average monthly payroll costs from the prior year. So again, there's nuances around what is in and out of that, but that essentially means that if your total payroll cost is above $4 million on an average monthly basis, 10 million is the max you're going to be able to get. If it's below $4 million, you will get something less than $10 million as a maximum loan amount. The incredible thing about this program is that there is a forgiveness provision, which makes this the closest thing to free money the United States government will ever offer. It could be full forgiveness. It's likely to be partial forgiveness, and the distinction on that is a function of how you used the money, which I'm going to go down to the bottom of the chart here for. The money is intended to be used for the cost of retaining employees, paying your rent, paying your utilities, and paying any interest on mortgage debt, not other loan debt, just mortgage debt as it relates to your facilities. So if you use the money for those purposes, and of course there's going to be a documentation requirement around that, then this will be forgivable. If you use it for other purposes, it will not be forgivable, or some portion of it will not be forgivable. But that is an incredibly unusual component of the PPP program. No collateral is required. The application requirement's relatively simple. It's going to be funded by the local banks and not directly by the SBA. So it's a local bank loan, SBA loan, that's going to be applied for with the bank, accepted by the bank, funded by the bank, backstopped 100% by the SBA. The compliance requirement on the backside is going to be a little bit more complex in that, as I mentioned earlier, you're going to have to be able to demonstrate how you use the funds, and you're going to have to be very clear then in your accounting to be able to capture that information. I'm going to qualify the time to funding here. As of yesterday, we were expecting that this was going to be 4 to 6 weeks. As of today, the program is now going to be open for applications beginning day after tomorrow, April 3rd, is what the Treasury Department is telling us. How long it takes to actually get money flowing through the system is unclear. Know this, there's going to be a line much longer than any line around any Costco in front of these banks trying to get this money. So it's probably going to take a little bit of time for most companies to be able to get the money from the bank itself. Whether it'll be 4 to 6 weeks, I don't expect it'll be that long at this point. The other great thing about PPP loans, no personal guarantee required. So it's, as I said, fairly simple form. On the other side of the equation are EIDL loans, economic injury disaster loans. Those are a function, a $2 million maximum loan, which with a function of you have to be able to demonstrate the economic injury that you have sustained in order to get the loan amount that you're going to be entitled to from the government. There's no forgiveness provision. This works much more like a typical loan. Collateral's required, personal guarantees are generally required. While the compliance requirement on the back side isn't all that difficult, the front side is a fairly complex application process to go through. The difference is you can use this money for a much broader range of purposes, for paying vendors and things like that, independent of the other things that the PPP is specifically intended to be used for. You can use it for both, basically. Now, I mentioned earlier that the CARES Act does address EIDL with something called emergency EIDL grants, and they've appropriated $10 billion for these grants that is waiving a lot of these normal EIDL rules. No personal guarantee is going to be required. Normally, you have to be able to demonstrate you've been in business for at least a year prior to the disaster. That's been waived. And also, normally, you have to certify that you're unable to obtain credit elsewhere. That has been waived. And to make this as easy as possible, the administrator may, and I emphasize the word may, approve an applicant based solely on the credit score of the applicant with no tax returns submitted. So they're trying to make that as easy as possible. But I caution this, it's a $10 billion appropriation, which may sound like a lot, but if $2 million is the maximum loan amount, at $2 million per, that's as few as 5,000 of these emergency EIDL loans will be available, at which point we'll roll over to the regular EIDL program. So know that. I mentioned briefly earlier the Emergency Economic Injury Grant, the EEIG. That is only $10,000. It's a subset of the EIDL program. So if you have an EIDL application and process, you can ask for this emergency infusion of $10,000. You get it in 3 days, no guarantees required, no collateral required as well. So that's an advance against the EIDL. It's obviously very small. So hopefully in a couple of minutes, that gives you a little bit of an understanding of the differences between the loans that are available through the SBA. With that, I'll stop. We have, I guess, about 3 minutes left for questions.
With the answers to your questions, I'll ask just a couple right off the bat. If I furloughed my employees, can I apply for the PPP?
Yes, you can.
Great.
And you can apply for both loans, both the PPP and the EIDL you can apply for. You cannot use them for the same purpose, but they are not mutually exclusive.
Okay. And if I have work available for my employees, but an employee doesn't want to come in out of fear of the virus, maybe they have a, maybe they feel like they're at higher risk or have a family member at higher risk, are they eligible for paid sick leave or unemployment?
I think that's a Shannon question. I think you're going to have to unmute her.
Yeah, I thought I unmuted everybody, but I will go through and do that again. There we go. Shannon,
Oh, here I am. I'm sorry. Can you repeat the question for me?
sure. If I have work available, but my employee does not want to come in out of fear of the virus, maybe they have a family member or they themselves are at high risk, should do they qualify for paid leave or unemployment?
That's a Felicia issue. Felicia?
There she is.
Oh, great.
Yes, I believe Felicia addressed that. And you can, I'm sure you can talk to that, Felicia.
Okay. So in that case, the general answer is no, unless they have one of those covered reasons under the paid sick leave, paid family medical leave, that they are having symptoms and they're on their way to a healthcare provider, for example.
Perfect.
But if you're in LA, the answer may be different. So look at the local ordinance.
Okay. And if employees are furloughed, same kind of similar question, but a lot of these questions came up. So I just want to make sure that people understand what their options are. If employees are furloughed, do we need to pay the 24 sick leave hours that California mandates?
This Felicia, no, unless they're sick.
Right.
If they're furloughed, they are not being given work. They are not in a paid status. So I believe the answer is no. That's the California paid sick leave.
Okay. And I'm just going to get to two more questions here, and then we're going to do the follow-up questions by email. So when you're calculating payroll expense for the PPP, do you include FICA and federal and state withholding? What is the calculation?
Well, the calculation is fairly complex. So I don't want to really necessarily dive into all the nuanced details of that. I would really strongly recommend that you get with your CPA and work through that process so that you get that specifically right, because obviously every dollar is going to matter in that loan.
Okay. And one more question. Can you apply for the PPP loan at multiple banks to try to get quicker responses?
I believe the answer to that question is no. It's first that one has come up, but I believe the answer to that is no. You have to certify that you're not. How do I phrase it? You have to certify that you are not going through other programs to get at this money. So I suspect the answer is no, one at a time.
Okay. And like I said, there are a lot of really great questions that came in that we did not have time to get to. I will be following up by email with responses to your questions. So thank you all to our presenters today. Thank you for attending today's webinar presented by Heffernan. We will be sending information by email with instructions on how to access a copy of the presentation, including the audio. And thank you to all of our esteemed presenters for your time and expertise today. We hope all of the attendees found today's webinar to be a valuable use of your time, and be sure to join us on April 7th for Conducting Workplace Investigations webinar. Thank you, everyone, and have a safe day.